Will your long-term care premiums go up as you get older? This is a very common question and a very common concern regarding long-term care insurance. Long-term care premiums don't work the way your automobile insurance does. Just because you're getting older or are diagnosed with an illness doesn't mean that your long-term care premiums will go up. In fact, your premiums can't go up just for you. Long-term care premiums can only go up for an entire class of insureds, and only after the insurer can prove to the various state insurance regulators that their claims for a specific class have varied significantly from actuarial expectations. In other words, if they raise premiums, it must be for cause and for an entire class of similar policyholders, not just you. So what this means is your premiums can go up over the very long time period that you'd expect to own a long-term care policy. In fact, it's not unlikely that they will go up. But you wouldn't expect them to go up every year, like a health insurance policy might. On the other hand, they may never go up. It just depends on the claims. Now, obviously no one wants to pay more. The good news is there are a few things you can do to try to limit the chances of an increase in your long-term care premiums. You want to purchase your policy from an insurer that is financially strong and that has a large risk pool. There are 3 primary ratings companies that will evaluate the financial strength of insurers. They are AM Best, Moody's, and Standard & Poor's. The ratings that are issued by these ratings agencies are important to you because they indicate the insurer's ability to pay claims, which is obviously important. Financial strength also allows an insurer to absorb more variance in claims experience than a firm with a weaker financial position. Just makes sense, right? The other issue is the size of the risk pool. In other words, how many people is that insurer insuring for long-term care? When it comes to avoiding premium increases, more is probably better. And that's because insurers rely on something called the law of large numbers. The law of large numbers says that the larger the sample size, the less variation there is likely to be from the theoretical expectation. And it is that theoretical expectation that your premium was originally based on. So, all things remaining equal, a larger risk pool will tend to reduce the chances of a premium increase. Just to give you an idea, in 2007, according to a survey done by Business Insurance Magazine, Genworth, the largest long-term care insurer, had 1,078,154 total long-term care policyholders. Okay, just over 1 million. MetLife, the second largest, had about 693,000. By the time you get down to number 10, there were only 30,000 policyholders. So remember that just because an insurer has a big brand name that you've heard of, or even a big presence in your local area, doesn't mean they are big in long-term care. An insurer could offer you a great policy at a very reasonable price, maybe even cheaper than anyone else can. But because they're only insuring you and your 2 neighbors, when Joe down the street has a stroke, then all 3 of you are likely going to experience a huge increase because you are the risk pool. Now, I mean, this is an exaggeration, obviously, right? But you get the idea. That insurer may be the absolute best choice for your car or tractor or even your life insurance, but not necessarily your long-term care insurance. Don't just rely on a brand name or the agent down the street. Do your homework. Now again, just to be clear, Financial strength and a big risk pool can't guarantee that your premiums won't go up. Nothing can. Nor is a company with a lower rating and fewer policyholders certain to have an increase. But insurance is, at its heart, an exercise in probability. And odds are, in my opinion, a strong company with a large risk pool is going to be less likely to have to go back to the states and ask for a huge rate increase because they underestimated the level of claims. If you'd like to see how your insurer or one that you're considering has handled premium increases in the past, just to let you know, most state insurance regulators publish that data showing which companies have raised their long-term care insurance premiums during the last however many years, the amount of the increase, and which states were affected. So go to your state's insurance board's website, and you'll most likely find that information. And by the way, if you need those website addresses, they're all on our website at snyderadvisors.com. Long-term care insurance is an integral part of a comprehensive retirement plan. Its job is to protect your nest egg from the potentially devastating impact of a large long-term care claim. So while knowing how much to budget for long-term care premiums over time is definitely a concern, it is not nearly as big a concern as how to budget for long-term care expenses when you have no insurance. When a client asks me how to project long-term care premiums forward in their retirement expense projections, I assume that premiums will increase over time by something similar to the rate of inflation. I feel pretty comfortable with that as a planning assumption. Again, provided that the insurance is through one of the big, say, 5 or 6 long-term care insurers. Now, the caveat to that is, of course, that's just our best guess. The other caveat is that the increase, if and when it comes, is probably unlikely to come gradually over time, like the increase in the price of milk, for example. But rather, it will more likely come in one lump sum, or even in stair steps. The key is not to be lulled by the fact that you haven't had an increase in maybe even 10 or 15 years. It may still be just over the horizon. And when it does come, the number may even be insultingly large, like 30%, which gets people really twisted up. But if you've had that policy for 20 years without a price increase, that 30% increase works out to only a 1.3% annual increase. My best advice is to go ahead and buy long-term care insurance early to protect against uninsurability. Don't hold off because you're worried about paying for something that you aren't going to use. That's the nature of insurance. Better to have it and not use it than to not have it and need it. Do what you can to limit future price increases, but build them into the budget anyway. If they never come, count your blessings. It's gravy. But if 10 or 20 years down the road you're subject to an increase, proper planning and budgeting will hopefully make it a non-event.